$470 a month in cash flow. It's the number everyone talks about at the real estate meetup. It's the number on the YouTube thumbnail, the one your landlord friend brags about at the barbecue. Here's the number nobody talks about. 2 a.m. The phone rings. The water heater is gone. The bill is $1,400. That's 3 months of profit vanished in one phone call. Meanwhile, his friend Marcus, who put the same starting money into simple index funds, is asleep. No tenants, no phone calls, no broken water heaters. Just a number on a screen that quietly grew while our landlord, Jake, was coordinating repairs on his lunch break. In the next 10 minutes, I'm going to show you the brutal math behind both decisions. Not the napkin math, not the YouTube thumbnail math, the real math, including everything that comes out before you actually keep a single dollar. Because the answer to which one wins depends entirely on which numbers you're willing to count. Let's keep this completely fair. Jake and Marcus both start with $50,000 saved. Both earn $55,000 a year. Same age, same city, same financial starting point. The only difference is what they do with that 50 grand. Jake uses it as a 20% down payment on a $250,000 rental property. It's a 3-bedroom house in a decent neighborhood with a tenant paying $1,800 a month. His mortgage payment is $1,330. On paper, that's $470 a month in profit. Jake feels like a genius. Marcus takes the same $50,000 and puts it into a total stock market index fund. He sets up a $300 automatic monthly contribution and doesn't think about it again. When coworkers ask what he's investing in, he says, index funds. They nod politely and change the subject. Nobody's impressed. On day one, Jake has a house, a tenant, and a story to tell at dinner parties. Marcus has a confirmation email. In terms of how it feels, it's not even close. But feelings and math are two very different things, and over 20 years, the gap between those two things will make your stomach drop. Now let's talk about that $470, because that number is doing a lot of heavy lifting in the real estate conversation, and it's about to get a lot smaller. First, property taxes, $3,000 a year. That's $250 a month gone. Then insurance, $1,500 a year. Another $125 a month. What about vacancy? The average rental sits empty about 1 month per year. That's a full mortgage payment with zero income to cover it. And when a tenant leaves, you're paying for cleaning, minor repairs, and listing fees, not to mention your own time screening new applicants. Then there's maintenance and repairs. You have to budget 1 to 2% of the property's value every year. For a $250,000 house, that's $2,500 to $5,000 annually. Some years it's a $200 faucet fix, other years it's a $7,000 HVAC replacement in the middle of August. And we haven't even touched capital expenditures. Roofs last 20 to 25 years, furnaces 15 to 20, water heaters 10 to 12. These are guaranteed future costs that come in chunks of $5, $10, or even $15,000. If you aren't setting money aside every month for these, you're not running a business, you're running on luck. Finally, there's the risk no one likes to discuss: bad tenants. A tenant who stops paying and knows the eviction process can cost you 3 to 6 months of lost rent, plus legal fees. That single event can erase an entire year's profit, or more. After all these real costs are factored in, Jake's actual net cash flow over the first 3 years is probably closer to $2,000 to $4,000 total, not the $16,920 that looked so good on a napkin. And that doesn't account for a single hour of his time. Let me paint a picture of Jake's actual Tuesday. At 7 a.m., he's at work. At noon, during his lunch break, his tenant texts about a leaking faucet. He calls a plumber, gets a quote, approves it, and follows up. At 6 p.m., he gets home and sees an email from the tenant about a neighbor complaint. He has to respond. At 10 p.m., his phone rings. The water heater is broken. The tenant has no hot water. It's January. He calls an emergency plumber. The bill is $1,400. In one phone call, 3 months of net cash flow are gone. Meanwhile, Marcus logged into his brokerage account once this quarter.
He saw the number went up, he closed the app, he went back to his life. Here's the thing about Jake's time that never shows up in the calculation. If Jake values his time at just $20 an hour, and he spends 5 to 10 hours a month managing this property, that's another $100 to $200 in invisible cost every single month. For 20 years, that's up to $48,000 in time that the spreadsheet never counted. The rent check is the number everyone talks about. The time is the number nobody counts. Now let me give real estate its due, because if I only focused on the expenses, I'd be doing exactly what every stock market influencer does. Jake has something Marcus doesn't: leverage. Jake used $50,000 to control a $250,000 asset. That's 5-to-1 leverage. Marcus used $50,000 to control $50,000. When Jake's property appreciates by 3 to 4% per year, he's earning that appreciation on the full $250,000, not just on his $50,000 down payment. By year 3, Jake's property is now worth around $275,000. His equity, the difference between what the house is worth and what he owes, has grown to roughly $60,000. That's real wealth, and it came partly from using the bank's money. That's the power of leverage, an advantage stock investors can't easily replicate. There's also depreciation. Real estate investors can legally deduct the theoretical decline in their building's value from their taxable income, even while the property is actually going up in value. It's a tax shelter that stock investors simply don't have. And with tools like 1031 exchanges, you can defer capital gains taxes by rolling profits into a new property, growing a portfolio tax-free in ways that are difficult outside of retirement accounts. These are real, powerful advantages. They're just not the whole story. So let's fast forward 20 years. This is where the story truly separates. After 2 decades, Jake's property is now worth somewhere between $450,000 and $500,000. His mortgage is nearly paid off, leaving him with $400,000 to $500,000 in equity. Over 20 years of maintenance, repairs, tenant turnover, taxes, and insurance, his total net profit from cash flow might be between $40,000 and $80,000 above his expenses. He's equity rich, but he's also exhausted. What about Marcus? His portfolio, earning a 10% annual return with his $300 monthly contributions, has grown from $50,000 to approximately $440,000. His total contributions over 20 years were $122,000. The other $300,000 plus is pure compounding. No debt, no tenants, no broken water heaters. Just a number on a screen that quietly grew while our landlord, Jake, was coordinating repairs on his lunch break. Here's the insight most content on this topic never addresses. The debate itself is a product. Real estate agents profit when you buy property. Mortgage brokers profit when you take on debt. Financial advisors profit when you invest through them. The entire industry profits from your confusion and from picking a side without running the full numbers. Those YouTube thumbnails promising that real estate always wins, they're often made by people selling real estate courses. The content insisting stocks always win, often made by people who sell investment products. Neither is exactly lying, they're just showing you the numbers that support their conclusion and leaving out the ones that don't. The real trap isn't real estate, and it isn't stocks. The real trap is picking either one based on a soundbite, a podcast clip, or something your uncle said at Thanksgiving, without ever running the full numbers for your own situation, including everything: the hours, the stress, the liquidity, the risk, the compounding, the leverage, the time. Because the answer that includes everything is the only answer that actually matters, and that answer is different for everyone. But it starts with running the real numbers, not the napkin numbers. Subscribe to Money Machine. Next week, we'll explore what happens when you do both: own property and invest in the markets simultaneously, and the math that might just change everything you think you know. See you there.